In this episode, we're going to look at the different types of retirement accounts available to you and the impact of taxes on your dividend income. Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, we're going to look at the following two topics. We're going to look at retirement accounts and taxes, specifically the impact of taxes on your dividend income. And we're going to look at that for Canada and the US. Now, just a quick reminder, tax laws change all the time and they're different from each province to state to country. So please consult a tax advisor for any tax rules that may apply to your personal situation. So first, let's talk about dividends because our episode today is about taxes and dividends. So dividends are essentially the profits that the company shares with you, the shareholder. So in this example, if you have a company that is giving a dividend of $1 per share and you own 1,000 shares, you'll earn $1,000 every year for as long as you own those shares and as long as the company continues to pay that dividend. You can spend those dividends if you wish, or you can reinvest them into other stocks that pay dividends. So in today's episode, like I mentioned, we're going to look at two countries, Canada and the US. So we'll start with Canada first. And here are just a couple of retirement accounts that are available to you. You can see the list on the screen. We have the Registered Retirement Savings Plan, the RRSP. We have a tax-free savings account, the TFSA. And of course, there's lots of other accounts here. We've got the RIF, the RESP, the RDSP. So there's a whole number of different types of accounts. We don't have time in today's episode to go through each one in detail. We'll look at the first two. So we're going to look at the RRSP and the TFSA. So if we look at the first one, the Registered Retirement Savings Plan, this is an account available to Canadians. It is funded with before tax dollars. That means you can put money into this account. It will reduce the amount of income on paper, the amount of income you earn in that year, which means that you will have to pay less income tax in that year. So this can be an advantage. If you want to put money into an RRSP today, you can reduce your income taxes that you would be currently paying. Now, of course, there is a contribution limit that's going to come from the CRA, and you can check it from there. Make sure you don't exceed the contribution limit because then there are penalties involved. Now, RRSPs in the year when you turn 71 have to be converted to a RIF. And then the following year, there are mandatory withdrawals. So at the age of 72, you have to start taking money out of those accounts. Now, the good news here is that your dividends and capital gains will grow tax-free in this account. Now, in this account, you can hold mutual funds, index funds, ETFs, individual stocks, and especially for us dividend investors, dividend-paying stocks. So you can own all of those assets in these types of accounts. Now, remember, you can take money out anytime you want. It's not designed for that. It's designed for retirement. So whenever you take money out of this account, it will be taxed as income. So it doesn't matter if it's dividends or capital gains. When you take $1 out of that account, the CRA is going to assume that's $1 additional of income for you. Next, we have the tax-free savings account, the TFSA. This account is funded with after-tax dollars. And this also has a contribution limit. So you want to make sure you check with the CRA. You don't want to exceed that limit. The good news here as well is the dividends and capital gains will continue to grow tax-free in this account. And the other benefit of this account is you can take money out anytime you want and it is not taxed at all. So this could be a good place as well for holding your dividend stocks. You can make dividends tax-free, and when you take the money out of the account, it will also be tax-free. Now, what about non-registered accounts? So the ones we were looking at were all registered accounts. That's a term that the CRA likes to use, so that's what we were looking at. But what about non-registered accounts? So this would be a plain trading account that's not an RRSP or a TFSA. This account, of course, you're going to fund it with after-tax dollars. There is no contribution limit. However, your dividends and capital gains are going to be taxed every single year. Okay, and whenever you take money out, that's fine. That's not going to get taxed, but the withdrawals are going to be taxed as dividends or capital gains. So how much is the tax? So you're probably wondering, right? So that's all going to depend on where you live. So in Canada, we have 10 provinces, 3 territories. They all have different rates. There's going to be the provincial rates, income tax rates on capital gains and dividends. And then there's the federal tax rates, again, for dividends and capital gains. So it's going to all depend on where you live. Now, we don't have a lot of time in today's episode to go through every single province and territory. So to keep it simple, I'm going to go through 3 examples with you. And what I've done is I've taken the 3 largest provinces by population. So we're going to take a look at somebody living in Ontario, someone living in Quebec, and someone living in British Columbia. Now, there's a lot of factors here involved, right? What are your tax deductions that you can make? Where do you live? How much did you make in dividends and capital gains? And again, this is outside of your registered accounts, so RRSP or TFSA, right? So a lot of factors come into consideration. Are you married? Are you single? And all of that will determine what you pay in taxes. To keep it simple, we're going to make some assumptions here. We're going to assume that in this case, your employment income, and so this person in this example has a day job, they're making $70,000 a year. They live in Ontario, and we're going to look at the income tax numbers from last year, which is 2024, and you can see it up on the screen right now. This person, and with no other sources of income here, we're going to keep it simple, capital gains, dividends, real estate income. We're going to keep all of that out of it. Just keep it simple, $70,000 employment income. You would be paying over $16,800 in federal and provincial taxes. So that leaves you at the end of the day with a little over $53,000 to keep for yourself. Now, someone living in Quebec making the same income of $70,000 a year will pay a little over $20,000 in federal and provincial income tax. And you can see that at the end of the day, they're going to be able to keep $49,991. And our last example, someone living in British Columbia, again making $70,000 a year, will pay a little over $16,100 in federal and provincial taxes. They're going to be able to keep $53,885. Now let's take a look at capital gains. Now again, we're going to keep it simple. In this example, the capital gains is going to be the same across the 3 provinces. We're assuming no other source of income. So somebody living in Ontario making $70,000 a year in capital gains, again, outside of a registered account, will pay $4,336 in federal and provincial taxes. So you can see how much money up on the screen that they have left after they've paid their taxes. Someone in Quebec will pay $4,789 in federal and provincial taxes, and someone in British Columbia will pay $4,029 in federal and provincial taxes. So now let's see what this looks like, again, for someone living in Ontario, Quebec, or British Columbia, what this looks like when they earn $70,000 in dividends. And again, outside of your RRSP, outside of your TFSA, what do you think? Do you think the taxes are going to be higher or lower? So let's take a look. So someone making $70,000 a year in Ontario, and these are eligible dividends, right? So the CRA has a very specific definition for eligible dividends. To keep it simple, this is going to be publicly traded companies. So if you were owning, let's say, TC Energy in Canada, Bank of Montreal, TD Bank, any of these companies tell us they all pay dividends. Those are eligible dividends. So somebody in Ontario making $70,000 a year, in eligible dividends has to pay $750 in federal and provincial taxes. So that is way, way much lower than what you would pay in $70,000 if you made in capital gains, or $70,000 in income. And in Quebec, on the $70,000 in eligible dividends, they're going to pay $1,935 in taxes. In British Columbia, take a look at that number on the screen. Someone living in British Columbia making $70,000 a year in eligible dividends will pay zero federal and provincial income tax on that amount. So they get to keep all of their money. So now we're going to put it all together. I'm going to stick with one example. Let's go with British Columbia. They seem to have the lowest tax rates for dividends, capital gains, and personal taxes as well. So we're going to put all this together for British Columbia, and we're going to look at $70,000 a year in income, or $70,000 a year in capital gains, or $70,000 a year in dividends. And you can see that the difference is staggering, right? If you were making that much money in as a salary, $70,000, you're only going to be able to keep $53,800 at the end of the year. If you were making that in capital gains, the same amount, you'd be able to keep $65,900 a year. But if you were making that in dividends outside of your RSP and TFSA, you would get to keep all of it. So this is incredible. So think about somebody living in British Columbia. Again, we're going to keep it simple, no other sources of income. If you're making $70,000 a year in dividends, you're not paying any tax on that. And if your spouse or partner is doing the same thing, that's $140,000 a year in household income in dividends, Canadian eligible dividends, and you would pay zero income tax on that. So this is extremely powerful. This is something to keep in mind, especially as you start saving for your future and you're looking to invest for your future as well. So this is a very huge advantage, tax advantage to dividend investors in Canada. Now let's move on to the US, and we'll take a look at it there. Same thing as before. The tax rates are going to be different from state to state. Please consult a tax advisor for your specific situation. I'm keeping things really simple. So let's take a look at the type of retirement accounts. There's the 401k, that's the big one. Most people have that, especially if you're working for an employer. There's a 403, there's a 457, and then we have the IRAs, the individual retirement accounts. There's a traditional IRA, there's a Roth IRA, and you can see them up on the screen here. Again, we don't have time to go through all of them in detail, so I'm going to just stick with the 401k as an example, and then we'll look at a Roth IRA. So the 401k is going to be the most similar to an RRSP that we have in Canada. This account is funded with before tax dollars. There is a contribution limit. Mandatory withdrawals have to start at the age of 73. And often there is a 10% penalty if you take the money out of this account before the age of 59 and a half. So you got to be careful about that. Make sure you're aware of that. The big advantage here is that the dividends and capital gains will grow tax-free in this account. So you can reinvest the capital gains, reinvest the dividends. It's all going to grow tax-free, which is fantastic. And remember, any money you take out of this account will be counted as income, right? So the withdrawals are going to get taxed. Now we look at the Roth IRA. This one is most similar to a TFSA account that we have in Canada. This account's going to be funded with after-tax dollars. There is a contribution limit. Another benefit here, same as the other accounts, is the dividends and capital gains will grow tax-free. And you can take money out of this account and it's not going to get taxed. So that's an advantage for you. What about the other accounts? In Canada, we call them registered accounts and non-registered accounts. In the US, I'm just going to say other accounts, the plain trading accounts outside of your 401k and IRA. And those are funded with after-tax dollars. Of course, there's no limit. You can put as much money as you want in there. Your dividends and capital gains are going to be taxed every single year. Now, we have 50 states in the US. Each state is going to have its own tax rate. Some states don't have state taxes at all for capital gains, personal income. So it's going to vary. Like I said before, consult a tax advisor for specific questions. I'm going to keep it simple here. We don't have time to go through all 50 states. What I'm going to do is take a look at 3 of the largest states by population. So we'll look at California, we'll look at Texas, and Florida. And that'll give you an example of what the taxes look like. And of course, I recommend to all of you, it doesn't matter where you live, even if you're outside of Canada and the US, there's a lot of online calculators that you can use to calculate your taxes on your income, on your capital gains, and dividends. So California treats all capital gains as ordinary income, right? It makes no difference whether you've held the asset for 60 days or 60 years. Upon the sale, you will be required to pay the state anywhere from 0 to 14% of your profits. Texas and Florida have no personal income tax or capital gains tax. Now, I got to put this disclaimer up on the screen here. Keep in mind, this is a simplified calculation, doesn't take into account potential deductions, credits, or other adjustments that could apply to your specific situation. You might be eligible for some federal or state credits that could reduce your overall tax liability. It's always a good idea to consult with a tax professional. I'm going to make some assumptions here, again, to keep all of our examples simple and short. So I'm going to assume single filer, and we're going to assume no other sources of income in the examples we're going to look at. So let's start with California. Again, we're going to look at last year's income tax rates for 2024. That's the other thing. Income tax rates change every year. The tax laws change every year sometimes too. So let's stick with 2024. In California, ordinary income of $50,000 a year. So basically what I did is for Canada, I was using $70,000 a year. That was Canadian dollars. I did a rough conversion to US dollars. So we end up with $50,000 US. So in this example, somebody living in California making $50,000 a year from their day job is going to end up paying federal and state taxes of $7,971. And in Texas and in Florida, I ran the numbers using an online calculator. The numbers are identical, so that's why I lumped Texas and Florida together. Making the same ordinary income of $50,000 a year, they will pay, if you live in Texas or Florida, $6,300 in federal and state taxes. You can see the after-tax income up on the screen. Now let's take a look at dividends and capital gains tax in 2024. So again, running the numbers using an online calculator with dividends and the same amount with capital gains, we find that the tax rates are going to be the same. So in California, whether you make $50,000 a year in dividends or $50,000 a year in capital gains, you will pay $2,470 in federal and state taxes. In Texas and California, the federal tax is going to be $806. So you can see when you compare this with income, so I have this up on the screen here, you can see that the tax rate, and now we're just going to look at Texas and Florida, just as an example, just like we did with Canada. We just looked at British Columbia as a simple example. So anybody living in Texas or in Florida, if you make $50,000 a year in income from your day job, you're going to pay $6,307 in federal taxes. Capital gains, $50,000 in capital gains, you're going to pay $806 in tax, and same thing with dividends. So you can see that there is a huge advantage in earning dividends because the taxes are much less. Now here's one last chart in our slide here. This is the US dividend tax rate for 2024. And you can see here for a single filer, if you're making anywhere from $0 to $47,025 in dividends, your tax rate is going to be 0. And for somebody married filing jointly, the range is from $0 to $94,000 a year, and the tax rate is going to be 0. So that's pretty good. You can make, as a single filer, up to $47,000 a year in US dividends. This is from US corporations, right? The tax rate's going to be 0. And then you can see up on the screen here, the tax rate goes up progressively. There's 15% rate, anywhere from 47 to $500,000, and then more than that, it's a 20% tax rate, right? So this gives you an idea of where you stand. Like I said before, I recommend to anybody watching, there's lots of online calculators depending on where you live, and you can estimate and figure out how much money you would be paying in taxes. So having looked at this, and we looked at the example with BC, right? Single person in BC, you can, in British Columbia, you can make up to $70,000 a year in Canadian dividends and pay no tax at all. So does this mean that you should go out today and invest in any dividend stock just to save on taxes? And the short answer is no. There's a couple of more things to look at. Our approach to investing is to invest in quality, dividend-paying stocks when they're priced low. So not just any stock that pays a dividend has to be a quality stock, and not just at any price. We want to make sure that it's priced low. So how do you know that when you're looking at any stock in the world? How do you know if it's a quality stock, and how do you know if it's priced low? So for that, I've created what I call the 12 rules of simply investing. The rules are designed to lower your risk, save you time, and help you earn more. You can see the 12 rules up on the screen here. The way this works is before you invest in any company, you have to make sure that it passes all of the 12 rules. If it fails even one rule, skip it. Move on to something else. So you can see them up on the screen here. Rule number 1, do you understand how the company is making money? If you don't, skip it, move on to something else. Rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is the company recession-proof? Rule number 5, is it profitable? Rule number 6, does it grow its dividend? Rule number 7, can it afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, avoid any company with recent dividend cuts. Rule number 10, does the company buy back its own shares? Rule number 11, is the stock priced low? And we look at 3 things there. We look at the PE ratio, we look at the PB ratio, and we compare the company's current dividend yield to its average 20-year dividend yield. And if it passes all the 3 conditions, then we know that the stock passes rule number 11. And rule number 12, keep your emotions out of investing. So we have an all-in-one solution. We've built a web application that will apply the Simply Investing criteria to over 6,000 companies every single day in the US and in Canada, and tell you immediately which companies pass which of the rules and which companies fail the rules. So you can see right away which companies you should consider and which ones you can avoid. We'll also tell you which of those companies are undervalued and priced low, and which ones are overvalued and priced high. So that's the all-in-one solution, the Simply Investing web application. And then the Simply Investing course is also available to you. It's a self-paced online course. We've got 10 modules. Module 1, we cover the investing basics. Module 2, we cover the 12 rules of Simply Investing. Module 3, we show you how to apply the 12 rules to any stock anywhere in the world. Module 4, we show you how to use the Simply Investing web application. Module 5, placing your first stock order. Module 6, building and tracking your portfolio. Module 7, when to sell, which is just as important as know when to buy. Module 8, reducing your fees and risk, especially if you own mutual funds, index funds, and ETFs. Module 9, we give you your action plan to get started right away. And Module 10, I answer your most frequently asked questions. So if you're interested in the all-in-one solution, you may want to write this down. Our coupon code SAVE10, SAVE10. It's going to save you 10% off of our all-in-one solution. If you enjoyed today's episode, be sure to hit the subscribe button, hit the like button as well. And for more information, take a look at our website, simplyinvesting.com. Thanks for watching.